Welcome to the Money Watch Show. It's Saturday, August 16th, and we are here trying to help you navigate whatever journey is in front of you. Mark and I are like Waze or Google Maps for your financial life. That's going to be our tagline, Mark. Soon it will be obsolete because they won't need us. They'll just do all their AI computations and they'll get the next best predictive outcome and we'll be obsolete. And I look forward to that. But until then, if you've got a financial question, you should let us know. Mark and I are both certified financial planners. And let me introduce Mark. Mark Talercio, welcome to our show here, our first weekend day of our vacation. How are you?
That's right. Today's departure day for me. Adios.
Bye-bye.
Ciao.
As everyone may now know, Mark is flying business class for his first time as a family, and I wholeheartedly support it. In fact, I wrote him a little summer bonus to help pay for that extra ticket. One of them, at least.
The tickets were actually floated after the after the election, and the stock market just went straight up.
Yeah,
said, this is a good time to take a little money off the table.
Exactly. Not bad at all. So, Mark, it's a funny time where I can't believe I'm going to have this conversation right this minute, because you mentioned that the stock market, was up very big after the election. Then we had the tariff-induced stock market sell-off, where we were almost in a bear market, almost 20% down from the recent highs. And then slowly but surely, stocks start clawing their way back, up, right? As we speak, which is, still mid-August as we're recording this, we see stocks just on a tear. So I found that this was a funny time to learn that the president was seeking to change some of the rules around what is included in a 401k account. Now, Mark, I have so many opinions on this, okay? But I thought what might be helpful would be for us to outline the issue by airing a segment that I did right after this executive order was signed. The anchors are Nate Burleson, Gail King, and Adriana Diaz. So let's jump in to the segment itself. And on the other side of it, Mark and I will talk about this. So here is the segment from CBS Mornings.
All right, so explain what this new rule would do and when it could potentially take effect.
Okay, so this is actually a rule that is saying to the Labor Department, which oversees all the workplace retirement plans, the Treasury Department, and the SEC, to kind of look at the regulations in place that might allow these different kinds of assets into our workplace retirement plans. And these kinds of assets, as you mentioned, crypto, there's something called private equity. It's like basically being able to invest in private companies, which really previously is only for rich people, and also private real estate. So this would be a rule that would have to develop over time. There's no law that prevents this right now, but right now what happens in the Labor Department is they say whoever is the plan sponsor has to put assets inside of the plan that are in the best interest of the participants.
Okay.
And that's what we think is going to be loosened up over time, potentially.
So risk and rewards.
Okay, so let's start with the risk. Okay. The risk is that these are volatile assets and they tend not to be liquid, meaning that if you want to sell them, sometimes it's hard to get out.
Yep.
And also, there are big fees associated with these kinds of investments.
Oh, really?
I mean, really big fees. Now, maybe they'll massage it for 401k plans. The promised reward would be, hey, you're going to make more money like all those rich people. A lot of rich people tell me that the kinds of things that they're going to put inside of 401ks will sort of be the leftovers. So don't get too excited over that.
Gotcha.
Are the rich people telling you that they want to do this too, or are they staying away from this?
Well, I asked one rich person at the table and a great investor, Nate Burleson. I said, what do you think? And
What'd you say, Nate?
Well, I just told her if you have the liquid cash and this is the back end of your portfolio, yeah, you can play around with it. But if you're just dipping your toe in the water, it might not be.
I think the tough thing for someone like me, who's a certified financial planner, all I want is people to participate in these retirement plans. That's all we want, is people to slowly but surely invest.
Yeah.
And the idea around investing is not to pick the best investment. It's to start early, slowly put more money in and try to keep it simple, stupid. We called it the KISS method of investing. Right. You don't have to be a brilliant investor. You have to have time in the market. You don't have to time the market.
So real quick, what are some common mistakes that people make?
I think, first of all, people don't participate. Right. They don't go up to their company match. And often we find, and we talked about this, when people get laid off, they'll pull money out of their retirement accounts before they're 59 and a half. That is a huge mistake. So if possible, participate. Try not to pick the most clever investment. All you have to do is be part of the plan and put a little bit more in every single time.
And if your company is matching, match it.
Make that match.
At the very least.
Exactly right, indeed.
Now, Mark, before we went to the break, when I first started talking about this, I mentioned that we are in a period of time where we call this in the biz risk on, meaning that it seems that everybody is just, I don't know, they're in feeling fine about taking risk, and there's all sorts of animal spirits that are roaring. And so at this moment, what do you think about these risky assets like crypto or private real estate or private equity inside of 401k plans?
Well, I think when we, you and I talked about this before we came on the air, and I think the first thing I said was, what in the world could possibly go wrong?
Yeah. I mean, I feel like I am not saying that you can't invest in risky stuff, but I want to just delineate a couple of things. Okay. Crypto is different than private equity and private real estate. And I don't know how these things are going to get priced inside of these retirement accounts. Okay. So I just want to say that crypto, you probably are more familiar with it. It goes up, it goes down. You may not understand like what the blockchain is. You may not understand what, just think of it as like, it is like a precious metal. It doesn't have any real use. And it's just an asset. You just buy it hoping that it goes up. There's no other use case for it. Okay. This administration has given a big boost to crypto assets and lightening up with regulation. And, maybe it's going to be fine. Maybe it's not. But you kind of get the big deal with this would be the actual volatility, the ups and downs. Okay. Private equity and private real estate, a little bit different. When we talk about private equity, what does that really mean? Private equity is when you invest in a company that has not yet gone public. It's not traded on an exchange. And what these kinds of investments have usually looked like is there's a company that gets a bunch of rich people, institutions, endowments. They get that money and they invest in these smaller private companies. They take a bet. They hope to keep their money tied up for 7 to 10 years. And they hope that they are able to go public or another company will buy it and they all cash out. So the limitation on private equity has always been that it's an illiquid investment. It's hard to get in and out of. So a lot of private equity funds, they give you like a window. They'll say like, you can't take your money out for 3 years, but if you do, this is what percent you can get out, the redemption amount. And I don't know how they're going to do this if they have it in a retirement account. Do you, Mark? Have you read anything that like, I don't know how they get liquid. If the market goes down and all of a sudden also like mark to market, what's this thing worth? Who knows, right?
Yeah, I have no idea how all this is going to be sorted out. But I will say this is the first step. There still needs to be many, 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 many more steps before this stuff, if ever, starts showing up in retirement plans. So I guess we'll have to see what happens.
Yeah, and what's interesting is that people think, oh, it's like a Fidelity or a Vanguard decision. It's not. It's, yes, the platform has to allow it, but if the platform does allow it, it's the company itself. The company, the plan sponsor, is the one that's on the hook. And the whole reason that these assets have not been included in retirement accounts is that the firms that are the plan sponsors, just think like any big company, when they have a plan and they have assets inside of that plan, if those assets are basically going down dramatically and people lose a bunch of money, then the plan participants can sue them. So let me give you a great example of this. A million years ago, there was a company named Enron. was like emblematic of like this big boom tech, blah, blah, not even tech, I'm sorry, big boom in companies that were doing really well. Enron was an electricity company, and then it expanded, and they had Enron stock inside of their 401k plan. And long story short, the company goes broke, the stock goes to zero, and all the plan participants sue, and they say, oh, you never should have had this stock inside of the as an investment choice. And this can happen with any company stock or any investment. So there have been some limitations now to how company stock is placed into a retirement plan. There really have been. This additional executive order is essentially saying the president saying to the Labor Department, which oversees all of the workplace retirement plans, the president is saying, hey, Labor Department, go talk to the Treasury Department and the SEC and make sure that the guidance that we are providing about all these different kinds of assets gives the plan sponsor enough leeway so that they don't feel like they'll get sued if they go down in value. So that's step one, is that they have to have a feeling, the company has to feel like, if I put this in the plan and the asset goes south, the plan participants are not going to sue me. So then they have to, even if that's the case, they might say, we don't want to put it in the plan. We don't want to, because no plan sponsor has to put anything in that retirement plan. It's up to them. And then it comes down to us, the participants. So, Mark, I mean, we've heard from people who have a big allocation into their company stock, not necessarily always inside the retirement plan, but a lot of plans, like I'll say that Paramount Global, under our old ownership, now it's a new ownership, but they have always provided a company match into the company stock. I think that's terrible. I think a rule should exist that you should not allow to have company stock inside of a retirement account. I just think it's a bad idea. But if you're going to do it, how much money, Mark, should someone have in one of these risky types of investments, or your company stock for that matter?
What do we typically say? Like no more than 5% or so?
Yeah, I would say 5 or 10. If you have a whole bunch of money outside of retirement and, 5% maybe up to 10%, that's it. That's all. And, I just feel like so often, I can't say this enough, there's such an emphasis on like, oh, I have to buy the right thing. I have to buy the right, oh, if I just bought crypto, I'd be rich now. You know what? If you just use a diversified mix of index funds with low costs and you keep socking away money, that's how you're going to accumulate some wealth. And I really do believe that when these plans if they get altered, my guess is that if the companies that put these kind of assets together, all they're doing is trying to make a land grab. These big institutions and endowments and all, they're all like kind of sick of private equity. They're they charge 2% a year plus 20% of the upside, the profits. And that means that if that is the same structure that's in a retirement plan, that would mean that you have 3 levels of fees that could be levied. One would be like a cheap index fund, which is essentially 0.1%. The second is a managed mutual fund, which is, let's say, 0.5 to 1% a year. These private equity and private real estate funds, they are 2% plus 20% of the profits. I mean, they better be good. I'm not convinced. Not convinced, Mark.
If they eventually show up, I will pay it no attention.
0. But I'm sure we'll hear from people. So anyway, if you've got a big allocation to some single investment idea, get in touch with us, because sometimes it happens by accident. Sometimes you don't realize it's all building up, and then boom, there it is. So we would love to help you out. And if you have a question about these new rules that could potentially go into place, or you have a question about just how do you get started in a 401k plan and what you should be doing and how much you should be socking away at what point in your work life, get in touch with us. Go to JillOnMoney.com, click the Contact Us button, write us a note, and then, of course, if you'd like to join us live, just check the box and Mark will do everything else. We drop our episodes on Saturdays and Sundays. And if you'd like to subscribe to us, you can do so on the Odyssey app or wherever you get your favorite podcasts. Try to lift someone up. Change your work, change your wealth, change your life. Thanks for listening. We'll talk to you tomorrow.